Mark Matthews joining us this morning, Head of Investment Research at Julius Baer. Mark, good morning. You know, last time we spoke, we were waiting for these election verdicts, and you had said that you really wanted to get the event risk out of the way before starting to put money back into India. What's your take after that resounding show? How quickly do you think you'll be looking at opportunities now?
Well, I think that the outcome does bring up certain opportunities, and the consensus had not been looking for the government to increase its share in parliament. In fact, it looked for a modest decrease in the BJP party, and therefore kind of more horse trading and backroom politics. And of course, now it's the opposite. There's an extremely large mandate, particularly from the rural sector, and that's the way I would look to play it, because, and you'll hear this from everybody else too, that this resounding majority allows them to push forward with a more pro-growth platform. And of course, another thing I should add is that in 2014, inflation was about 8%, and today it's about 3%. So I think that the government will go to a more pro-growth strategy, and favoring the rural sector. And I also think that reforms in the areas of labor and land will favor the rural sector. So I would be looking to find companies involved in that. I think that would include consumer infrastructure. And I do think also that there was, generally a lot of concern among people. How should I say that GDP growth was slow, etc. And now I think that people are more interested in stocks, confident in the economy. Therefore, the mid-cap sector also has room to catch up.
That's interesting that you make that point, Mark, because, the broader market recovery has been in sight for a while, but it's been a stark 1.5 year long of underperformance. Within pockets, or rather where within the broader caps, do you think that the recovery would come in? And would it be the more economy, government-linked sectors, infrastructure, roads, and maybe the public sector-owned companies where you see a bigger recovery as opposed to the broader space?
Yeah, I think definitely roads are a big one, and mass market consumer, fast moving consumer goods, where, what's interesting is India, 62% of the population is in the rural areas, connected to agriculture, but agriculture is only 17% of GDP. And that's not because agriculture is bad. I should say it is because it's bad. I want to say it's really because agriculture has been so inefficient in India, and if it becomes more efficient and therefore a larger part of GDP, then that 62% of the population which is involved in agriculture will have more money to spend, and that would come back to the idea of buying mass market, fast-moving consumer goods.
Okay. So those are a couple of the themes that you're looking at. What about the financials, Mark? Where do we stand there? Last time, you clearly, sort of highlighted the difference between the public sector and private names, talked about perhaps a shift in investor interest from one pocket to the other. What's the status there now? How are you looking at the financials?
I don't know if we've really changed on that. I think the major driver of the financials is more their balance sheets than their earnings. And, well, I suppose they're related in the sense that the earnings have been suppressed by the massive provisions that they've had to take to write off non-performing assets. But the good news is I think that we've reached the peak in NPAs, and I would have thought intuitively, therefore, the biggest beneficiaries are the PSU banks, which have started to show significant improvements actually in their bottom line. So I'd be more in the public sector side in the banks right now.
Mark, so do you think India, which has seen a massive P expansion and not an earning expansion, because when India 1 came to power, the promise of promised land was very high. This time around, we may not see that kind of an P expansion because the scope for Ps to expand for individual stocks and for the index now is not there.
Right. So that brings me back to the way I would play it is finding very specific sectors, which, as I said earlier, like infrastructure, road builders, companies that sell consumer products to rural people, or since we touched on the financial sector, public banks whose NPA provisioning has peaked. But for the broader market, I do agree it's an expensive market. The good news is that of all the countries in Asia, India has the highest earnings growth this year at about 20%. And even if some of that is shaved off because the analysts were too excited, I still think it would be, at the very least 15%. But yes, I would prefer to be in the mid-cap space and those sectors than just broadly in the Sensex. Having said that, if Sensex can break 40,000, which is, obviously psychologically a very big round number, I think it could move much higher.
Sure. Mark, we've also been talking a lot about how perhaps the new government's reform agenda could be the fillip we need to drive momentum further from here, given that markets are now steady at these high levels. It's really all about sentiment, and if we hear perhaps the correct noises coming in from the new government, perhaps valuations are not really going to be the focus, but more on that broader based rally. What do you think? What do you feel they could say that would really drive momentum from here?
Well, to me, it's two L's, land and labor. So if they change the labor laws to make it easier to, I hate to say it, but fire people in the public sector, I think you would see huge interest in India on the part of foreigners, because it's well known that public sector is bloated and inefficient, and therefore there'd be great gains to be had from more efficiencies and in the private sector as well, but generally to make labor market more flexible. I think that's been a huge thing holding it back. And by the way, generally countries with large populations, that's the way it is, because the public sector does employ a lot of people, and it's a form of unemployment almost to give people jobs just so they've got something to do in countries like India, Brazil, Indonesia. So anyway, labor, and the other one's land. And to come back to what I said earlier, there's so many efficiencies to be gained in the rural sector in India from even getting rid of the mafia and the way they can hoard vegetables and grains to make their prices go up and squeeze the consumer. And better transportation, of course, would massively bring down the price of food, which I believe is the biggest component in the CPI basket. So many things that could happen, good things that could happen in India to make the country more efficient and therefore the economy bigger.
I'm just going through your notes, Mark, and while you do believe that growth in Europe is going to remain a challenge, which is understandably so, you also see a risk of recession in the US within the next 2 years. What's making you uncomfortable about the US economy? And is it, the most obvious one, the large corporate debt that, corporate America is sitting on?
Well, to be clear, we are forecasting a recession, it is true, but only very mild. So we're looking for 2 quarters of negative GDP growth in the second quarter and the third quarter of 2021, which is obviously still 2 years from now. So I wouldn't worry about a recession in the US just yet. And why are we calling for one? To be honest, the reason is that it's just been so long since there hasn't been one. The economic cycle now in the US is about 9 years old, and typically they don't last that long. Typically, I can't remember exactly how long they've lasted on average, over the last 50 years, but typically it's around now that you should start to get one. And the New York Federal Reserve does run a useful indicator called probability of a recession over the next 12 months based on a variety of inputs from the yield curve to inflation. Anyway, that indicator has been very predictive, very, very accurate in forecasting recessions. It's on the internet. If you just Google probability of a recession over the next 12 months, New York Federal Reserve, it's the first thing that pops up. And what I want to say is that it was only indicating a 10% probability of a recession 12 months forward back in January. And as of April, which is the last data point, it's gone to 27. So obviously 27 is not 100. We're still, it's not still flashing red, but it's that trajectory which has increased quite suddenly. And in the past, actually, I kind of eyeballed it. And when it would get to about 40, then you could be pretty confident there was going to be a recession that followed.
Really appreciate your time. Fantastic to have you back, and certainly hope to see much more if you're going forward. Mark, so we just put a picture out of yours. Maybe it's a 15-year-old picture, and I must say that you're looking different.
It's not years old, but anyway.
All right, Mark. Hope to see you much more of you going forward, and look forward to hosting you in our studio when you are in India next.